All right, what is up, Albert? How are you doing today, sir?
Man, I'm doing well. Another fabulous Monday.
Fabulous Monday. We got a
Yeah,
we got a new series. We're gonna start today. Welcome to the REI 101 show slash YouTube video slash podcast. We're gonna be streaming on Spotify and we're gonna be streaming on Apple Music. But let's go ahead and get started. We are going to also be live streaming on Facebook today.
cool.
Um, so we're everywhere. So if you are watching this in the future, welcome. If you are watching this in the present, uh, welcome, welcome, welcome. And then if you're in the past, I'm not really sure how that works. But if you want to be on our call, we do this call every Monday, 12:30. We talk about real estate investing one-on-one. So we talk about the basics. We talk about how to get started, how to mess up real good, and all the fun stuff. So I am Austin from Houston. This is my one of my favorite people in the world, co-host Alberto,
Hello.
Medellin. We do deals. We talk. Hey man, I went running this morning too. So I ran 5 miles. So
Okay. Yeah,
so
that's good.
I got to catch up with get caught up with you. You've been running a lot, haven't you?
Yes. Yeah. Did a 10 miler on Friday and it felt good. It wasn't bad. It wasn't
Oh,
awful.
okay, okay. Well, my next goal is to run the Houston Half Marathon. I'm
That's a
getting
good one.
redemption for breaking my hip in 23. So, so let's get started. Hard money. A lot of people use this. This comes up all the time. This is part of our funding series that we're going to be doing for the month of July. So July is all about how to find the money. So today we're going to be talking about hard money. What is hard money? Where does it come from? How do you get it? How much do you need? How do you pay it back? And next week we're going to talk about private money, which Albert and I and others on the call have experience with private money, raising capital the right way and the wrong way.
Yeah.
And then hope to have a special guest on for July 28th. We're going to talk about DSCR, SBA loans. Can you buy a multi-million dollar commercial asset with 0% down? There are ways to do that. We'll talk about HELOCs, creative lending. So this is our funding overview. So Albert, hard money, yes or no? Is it a good thing? Is it a
Um,
bad thing?
I mean, I look at it like I look at like each way that we fund these deals and how we find deals, how we fund deals. It's like you're building something and you have specific tools that perform a specific function. You know, if you only have a hammer and you're trying to build a house, you're gonna have a hard time, right? So
Right.
if you only work with hard money lenders, you're probably gonna have a hard time eventually. But I look at hard money loans as a tool. Typically, it's a really good tool to use if you're just getting started. You know, you need to get that deal. The numbers have to make sense, of course. But we did maybe the first 10, 12 deals using hard money. And, we can kind of go over what actually it is. But to answer your question, I think yes, if it's going to get the deal done and the numbers make sense, that it's a tool that is to be used appropriately.
Yeah.
You don't want to hurt yourself, and so that means like don't over leverage and make sure your underwriting is sound. But yeah, I like hard money. I like not all hard money lenders are created equal,
No.
but I do like hard money, especially if you're just getting started.
Yeah, and I think that this is an area where reputation really comes into play because, like you said, not all hard money lenders are equal. Not all hard money lenders are very organized, and the ones that are organized that are on point, that makes a big difference because those guys can actually help you and they can protect you from um, you know, making mistakes or getting yourself into trouble. So we've seen the good, the bad, and the ugly when it comes to hard money. My personal experience for me personally, hard money's been I've had nothing but good experiences with
Yeah.
hard money.
Yeah, I think for the most part, I would say every experience was positive. You know,
Hmm.
I was able to get draws on time. Payoffs were fine. I think I agree what you said. Some are more organized than others. Hard money lenders are more organized than others. So when you thrive on processes and communication, and your hard money lender kind of lacks in that area, then you can see those deficiencies and it might just kind of annoy you. But I think for the most part, like funding deals, right? You're going to go close on a deal and you have your hard money lender, like you signed all your documents and your hard money lender is there to fund the deal. So I've
Right.
never had any problems funding deals. And as I mentioned, getting draws from the hard money lender to pay my
Hmm.
contractors, those experiences have been fine. I've only used two different hard money lenders though, and there's a lot of them out there, but I've primarily just used a couple.
So I think what it helps if to compare or contrast hard money with there's three ways, three broad categories that you can put borrowing money into. So if you're thinking about borrowing money, there's three ways you can do this. Number one, you can go to a bank, and we'll talk about that in the third series. Banks have different products. They have different types of loans for different type of, whether it be HELOC or whether it be SBA loan or the SCR loan. And we'll talk about those different type of products as well. Um, Banks, most people's experience with borrowing money is their mortgage on their primary home. And that's going to be some type of conventional mortgage that's going to be the lowest interest rates. I think a misconception is you can't really use that product the same way to buy investment properties, right? It
Right.
doesn't quite work the same way. Now you can, but generally there's going to be different terms. Your down payment's going to be a little higher, and the interest rates are going to be a little higher on those type of loans. But they serve a purpose, and we're going to talk about that as well. Private money is just basically me borrowing money from you or you borrowing money from me. Me
Right.
just giving you some cash, and that's an incredibly valuable resource if you are connected with the right people, and just like you have a credit score, you have a reputation with people. So some people that's family, friends, other
Yeah.
investors, and there's different those terms are purely negotiable.
Yeah.
With
And
hard,
I think too, like with hard money, like why people would choose hard money, right, over a conventional loan, or a bank loan, for instance. With bank loans, you have an inspection of the property
Mhm.
and the bank, the underwriters have a minimum requirements of those inspections, before they'll fund the property or underwrite the property. And a lot of times investors are looking at properties that, have a hole in the roof or they're
Yeah,
missing subfloor, or the electrical's all been ripped out, or the house could be fully gutted. It's not really livable. And traditional banks, they're not really going to fund a deal that looks like that, right? So
right.
hard money lenders will do that. I think too, hard money lenders, they typically close a lot faster than a conventional bank. Conventional banks can be anywhere from 45 to 60 days to close.
Hmm.
Hard money lenders can close within a few days once title is cleared and all that. Like once the title gives clear to close, hard money lenders can typically close between 24 to 72 hours.
Yeah, it's
And
almost as good as cash.
almost as good as cash. Yeah,
They'll
yeah. And I
say it
think
is as good as cash, but it's
yeah,
almost as good as cash.
almost as good as cash. And I think according to Trek, it's still financing, right? It's
Yeah,
not really considered cash, right?
and
And
that's a
one of the
recent
things,
that's a recent update to the Trek guidelines
yeah,
too, because we used to write those offers as cash and nobody would know the
yeah.
difference, but
So I'm
now
married
you
to
have
an
to
agent.
disclose it.
She
Yeah,
keeps me up to date. So
she keeps you compliant, huh?
yeah. And so the other thing too, what's really why people prefer hard money lenders too is, they're not looking at your income like a bank is going to look at.
Right.
They're looking at the potential for that asset, for that hard asset. That's why they call it hard money. They're looking at how that asset's going to perform, whether it's a rental property, they want to look at how much income it's going to generate, or even a multifamily property, right? They want to look at how much income this is going to generate,
Yeah.
and they put some calculations, right? And to determine what's the maximum they can loan you on that property
Right.
based off of the income or based off of the after repair value of that property if you're going to sell it as a flip or something.
Exactly. So basically, to summarize it to 4 points, investors are going to choose hard money because number one, it's fast.
Yes.
There's speed, and when it comes to making deals, time kills deals, and hard money limits that. Number two, distressed properties. We know that conventional, traditional financing, a lot of times they won't touch a distressed property if it needs too much work. So
Hmm.
hard money lenders, they love these dilapidated, deferred homes with deferred maintenance, just properties that need a lot of work. That's what hard money is for. Then you said there's no income documents that are needed. Um, and then it's really good for short-term opportunities.
Right.
Now, now a good question is, can hard money be combined with conventional financing? Can you use a combination of the two? And if so, what would that look like?
That I'm not 100% sure. I know some hard money lenders, they're going to want to be the first position lien holder on the
Yeah,
property. And they may have something in their disclosures. I know the hard money lenders I've used before where they won't allow a second position lien. So I haven't really worked in combination together on the purchase of a of a distressed property. Now,
right.
I've worked with hard money lenders that have a long-term lending department where they're like, hey, we'll fund the short-term, right, rehab of the
Yeah.
project, and you're going to keep this as a rental. We'll go ahead and start the underwriting on the long-term loan too, right? You just have to pay closing costs for one loan, right? They try to incentivize you to stick with them to refinance into the longer term, like conventional, financing after that. But I've never used, I think, like a bank loan with a hard money loan.
I don't think you're going to see that in the residential side, but what we do see is we see a hard money loan. We'll see someone buy a home, use the hard money to pay for the rehab. And then once the home is in a appraisal ready condition for a conventional loan, then restructure the loan and refinance it with a conventional loan. So
Okay.
I always try to encourage investors, especially investors that are looking at single family homes, is is you always want to have three plans. Like if your first prerogative, your first objective is to flip the house, like hard money all the way. But it's a good idea if you're in a position, and this is important, I think, especially in a market like ours, where the market is somewhat volatile.
Hmm.
It's a good idea to be in a position where you can finance it and hold it for a year or 2 years in the instance that you can't sell it for a profit like you thought you did. Like maybe you're off on your numbers, and or maybe you went over budget on your rehab, and then you're at a point where, hey, I'm actually going to lose money on this deal. Well, you don't have to lose money even if you're over budget, if you're willing to hold on to the property. Um, you just can't. You're just not typically going to want to use hard money for a long-term hold.
Right.
Interest rates are
Correct.
much higher. So
Correct.
the perfect purpose of it is just to get in and out as fast as you can. So some questions. Is it a scam?
Maybe.
Maybe. I think the answer could be maybe. I
Yeah, I
think
think the answer is maybe. I think one of the things, we'll talk about a little bit later, like predatory lenders and things like that. But I would say this: if you are getting unsolicited emails in your inbox as an investor talking about a person wants to fund your deal 100% or fund your deal to 80% LTV. We'll talk about that later. And they're just sending you an email out of the blue and it just looks like a friend sent it to you.
yeah,
Report spam, delete report spam. Like I would rather deal with reputable hard money lenders,
yeah,
than someone who's just sending me an unsolicited email. So is it a scam? Maybe, right? Do your due diligence too. Even do your due diligence with these reputable ones, because again, they're
Hmm.
not all created equal. They have different types of fees. You want to know what kind of questions to ask. And if you're listening here, you'll figure out some of those questions you want to ask those hard money lenders. And we can talk about some of those too, right? That was the first one, right? Is it a scam, and will they lend 100%? Maybe. So that's
I
another
wouldn't.
answer.
Yeah.
Same answer to question two. Maybe. Some hard money lenders do fund 100% of the purchase and the renovation of the property if it falls within this equation they use, right? They'll
Hmm.
fund up to like 70 or 75% of the ARV or the LTV.
Right.
So if you have a property and you can sell it when it's all fixed up for $300,000, and that lender is going to lend you up to 70% of that, then they'll lend you $210,000.
Right.
If your purchase and rehab costs are less than $210,000, they'll fund 100% of that. So really all you're bringing are closing costs to the table.
Yeah.
So we've done a
Absolutely.
lot of deals like that.
Yeah. So the better the deal is, the more money you're going to get for it. You'll have more wiggle room, right?
Yes.
So
Yes.
will they limit you 100%? Yes. Typical terms, you said the 70 to 75% A
Yeah.
uh ARV, right?
Some
So
hard money lenders too, Austin, they'll require you to put down some money. Like they'll require
yeah,
you to put down like 10% of the purchase. Like they'll fund 90% of the purchase and
right.
100% of the rehab.
Yeah. Yeah,
They want you to
that's
have
right.
some skin in the game.
So homework assignment for our listeners is to get two or three of these guys in your database this week. This is a really good place to start. Um, we can definitely connect you with some hard money. We had Aiden Mosher on. If you go back to our first episode, he had a lot of really good information about flash funding, and we, King James, and we have a lot of different uh, recommendations that we can give for hard money. So,
Yes.
um, and then how fast is it? Well, you said 24 to 72 hours in some cases. If
Yeah,
it's
yeah, yeah. Once you get clear to close, from the title company, um, they can typically close. A good hard money lender can close within a few days. And now that takes prep work too,
Yeah.
on your side, right? Is um, when you're working with a hard money lender, what I've noticed is there's a lot more, I guess, tasks that the investor has to take and do. Like they're kind of driving the bus a little bit more,
Hmm.
as opposed to Austin when you're representing a buyer or an investor that's using conventional funding,
Hmm.
right? You and the title company are kind of handling communications with the bank, with the lender,
Right.
right? Making sure everybody's on time with their documents and things like that. What I've noticed working with a hard money lender, even when there's agents involved, I'm kind of responsible talking back and forth to the hard money lender. Hey, we have these documents? Do you need a survey? All of these
Hmm.
things, right? So I felt like I had to take on a lot more of those tasks when I was working with a hard money lender. So how fast can you get the money? Make sure either you or someone responsible is driving
Yeah.
that bus and he gets there on time.
You just gotta have good communication with them.
Good communication.
And they are going to qualify. They are, typically in your experience, hard money lenders, do they normally have their own appraisal that they do, or they have somebody go
Yes,
out
yeah,
to the property?
they'll do an in-person appraisal. Some will do like a desk appraisal. And what we teach our students in our mentorship program is when you're working with a hard money lender, you want to be very detailed in your scope of work and your
Hmm.
budget.
Right.
Because if let's say you buy a property for 100,000 and the
Hmm.
ARV is 300,000, right?
Right.
And you may have to put 100,000 in that property to get to that 300,000, right?
Yeah.
But if your scope of work and your budget says, well, I'm only going to put 25,000 into it, that property is probably not going to be worth 300,000 when you're done with
Right.
it. So
But it,
having good documentation and a good contractor that can help you with those estimates and documenting those and presenting that to
yeah,
your hard money lender, they use that with their appraiser to come up with that ARV.
these good hard money lenders, they're going to check your work, and if they're not going to let you lose money. These good
They don't
guys are
want you to
not going
lose
to.
money because they don't want that property back, you know?
And if you have the emotional intelligence to recognize a predatory lender, you'll see that they'll be way more open-minded than they probably should be about a lot of deals. And
Yeah, they are pretty conservative though. What I've found in my experience, they are a conservative, more conservative than like
Mhm.
I usually am, which is I think acceptable, especially if you're just getting started. I'd rather a hard money lender tell me like, "Hey, this is not a good deal," and that lender has more experience than I do. I'll just move on. I was like,
Yeah.
"Okay, cool," move on, or try to get it at a better offer, to make it a good deal.
So do I have to have experience? The answer is no. You don't.
No, you don't need experience. It helps though when sometimes you do get better rates if you have experience, especially if you can create a relationship with a hard money lender and you
Hmm.
do multiple deals with them. They may come down on their interest rate, they may come down on their points that they charge you. They may be faster on their draws, things like
Yeah.
that. But that's relationship based.
Yeah, absolutely. So let's talk about let's talk about the terms because uh, I have seen people use hard money for rental properties. Is that a yay or a nay? Thumbs up or thumbs down on using hard money for rental properties?
So we've used hard money just to purchase and renovate because we're always buying distressed properties, and if we're going
Hmm.
to keep them as a rental, as we talked about before, right? We just refinance those into DSCR loans, But again, we'll use hard money to just get in, buy the property, renovate it, then refinance it and get out. So yes, for rental properties, we'll use hard money, and typically hard money lenders will treat a rental property as less risky than a flip. So if you tell them that up front, you may actually get a little bit better rate
Okay.
and terms,
No, I didn't know that. So if you're going into it
Sometimes.
saying
Yeah.
saying, on 3 months I'm going to refinance a conventional so I can hold it as
Yeah.
a rental property, you may get better terms.
You may get better terms.
Okay. Well, that might be a good question to ask your hard money lender if if plans to hold it as a rental can provide better terms on that.
Yeah.
So let's talk about the terms of hard money. First, we got interest rates. So
Yeah.
conventional, right now, I checked Fannie Mae this morning. The average conventional mortgage, 30-year mortgage right now is at about 6.72, if I remember correctly. It's right around 6.7%. We have a
Yeah.
lot of clients right now, they're locked in the twos, and
Yeah.
they get locked in. So with interest rates, what are you seeing as far as interest rates with hard
For
money?
for hard money lenders, I've seen a range from about hard money lenders that we've used personally right now, they're at about 10.9% to about 12.9%.
Okay.
There are some other hard money lenders out there that we haven't used yet. There's a California-based lender that has 8.5%. Haven't used them yet, so don't really know if they're good or bad. But the Houston, some of those that are funding in Houston, like Jet Lending,
Hmm.
King James Lending, Catalyst Funding, Easy Street, all those people are in between like 12.9 and like I'm sorry, 10.9, like 12.9%.
Yeah, somewhere around the 12%. What
Yeah.
about points, buying down the rate, anything like
Yeah,
that?
so points, you're not really buying down the rate. Points are really kind of how like though their staff gets paid,
Hmm.
and just think of points as that's your upfront fee. It doesn't get applied to the purchase price. It doesn't get applied to your closing costs. It is just an upfront fee. Like they want part of that interest upfront, and that's going to be anywhere from 1 to 3 points of the total loan. So a point
Okay.
is like 1 percentage point of the total loan. So if you have a
How
three
do
hundred
they
thousand
how do they
dollar loan,
determine that though? When you say 1 to 3%, how do they determine that?
so it really just it depends on a couple factors. One is this is just their underwriting like benchmark. Is like, hey, we're at 3%.
Hmm.
But as I mentioned before, if you have experience with them, you have a relationship with them, you've done several deals, then you can start negotiating those points.
Yeah.
Hey, I've closed 3 deals with you guys. I've flipped out or refinanced out of those, and can you come back on our fourth deal? How about 2 and 3/4 points or 2.5 points? Right? You can start working that into your negotiating.
And then loan to value, they're looking at, how much this property is going to be worth when you're done fixing it up.
Right. Yeah, so that 70 to 75% is, I think typically it's about 70%. Some do 75%, but They're looking at loan to value or that ARV, that after repair value of the property. If you can resell it, if it appraises that after repair value at 300,000, and they're loaning you 70% of that, then their max loan is going to be 210,000. You
And
know.
they will take your rehab budget into factor too. I don't know if our guys will want to see an itemized list. The first time I used hard
Yes.
money, this is kind of interesting. They wanted to see the itemized bid from the contractor,
Hmm.
and this is way before I knew Javier. The contractor I was using literally said, "I don't do that. I don't itemize the work. I tell you everything that needs to be done, and I give you a bid." And they were like, you can't do that. You have to have an itemized bid." So never would have thought about that, but make sure your contractor will itemize the different, everything that's going to be on that bid.
Yeah. Not every contractor is going to do that either until you accept their bid. Honestly, I haven't met a contractor that is willing to itemize a bid until I accepted his bid.
Yeah.
He's just not gonna itemize every estimate that he gives me. So, but if I'm getting close and the numbers make sense and I'm going to put this under contract, then once I'm under contract and I'm working with the hard money lender at that point, I've already talked to them, gave them some rough numbers. They
Hmm.
also kind of feel good about it as well. Then I'll get that itemized bid from the contractor and send that over. Or I have like a spreadsheet that I just plug all those numbers into and I send that
Right.
over to the hard
Right.
money
Right.
lender.
Um, how do they underwrite this deal? So your your agent's going to run comps, or you're going to run comps.
Right. You're
What
looking
else are
at
they looking
comps.
at?
You're looking at so it depends, right? If you have if it's going to be a fix and flip, if it's a single family home, right? You're
Hmm.
doing yourselves your CMA, right? Your comparative market analysis on that property, and that's really what the lender is going to be doing too. That's how they're
Right.
underwriting it. They're also going to look at your credit score as well,
Yeah.
and they're also going to want you to have some reserves in the bank as well. Because typically a hard money lender is going to want you to get the renovation started. So they're not just going to give you money to go put a down payment in with this contractor. They want you to get the
Mhm.
renovation started. So you, the investor, are also going to have some cash in the bank. So that's
Right.
also like part of their underwriting is make sure that you can cover about a third of the renovation.
Yeah.
They want to make sure you've got that in the bank.
They want to know that you're carrying part of the risk, that it's just not all on them as
Exactly.
lenders.
Exactly.
All right. So let's talk about common mistakes. So we got six common mistakes. We could probably think of a few more. I think as we talk through this, we always start thinking about mistakes that we've made or we've seen clients make. So the first mistake is overpaying, and that's
Yeah.
due to an unrealistic after repair value. Um,
Hmm.
we did we did an analysis, and we do this every first Monday of the month where we take a deal and we look at the analysis. And with experience, Alberto, I know you probably can do this. I feel like I've been pretty good at this, but we can usually just look at a property and estimate how much the rehab is going to be and how much
Yeah.
money we're going to have to put into it. And we want to try to make that 20% profit, 30% profit,
Yeah.
off the deal. But there are some little things I think people miss that will really affect the ARV if they don't know how to run comps. So having an agent like who's really awesome, like really amazing at running comps is
Yeah.
important because like a swimming pool can throw the numbers off. Um,
Or a busy
uh,
street could throw the
Being
numbers.
on a busy street and you have four identical homes, but they're deep in the neighborhood.
Yeah.
Another thing is um, comparing homes with a pier and beam foundation against homes with a
With a
slab.
slab. Yeah. That's
Um,
another one.
com Comparing older homes to newer homes. You got to think about that. Also, another thing is one thing and we can talk about running comps all day long is most MLSs, if you run a search by, like, for instance, like a city, like say you're buying the best example is Nassau Bay. If if you buy a house in Nassau Bay, there's a couple of variables in that town that really mess up the comps if you don't know what you're doing. The first variable is half of the listings sold in Nassau Bay is listed as Houston.
Mm.
So the
Okay.
way to get around that, the only way you can get around that is instead of typing city into the search bar when you're running comps, you just have to draw a
Okay.
map around it.
Hmm. Gotcha.
So so that's just like one of those little things. Like if you just say, show me everything in this neighborhood or in this city, well, you may miss half the comps if you don't know that half those houses are listed as City of Houston. The second
Gotcha.
thing, Nassau Bay is has a very dynamic flood zone. And those that can really, ruin somebody's day. Buying
Hmm.
a home that's in a flood zone and you're comparing it across identical homes that are not in a flood zone, um, that can that can create problems because one, a lot of people don't want to buy homes that are in flood zones. Number
Right.
two, the insurance is just going to be so much more expensive. The holding costs of that property is going to be way higher if you don't know that. So that's where it comes in. That's where it's really important to have an insurance agent that you can go to and they can run
Mhm.
quotes on it as well. Any
Yeah.
other any other criteria that I think that you think people miss when running comps? Because I think this is a really easy way to lose a lot of money is not running good comps.
Correct. I think looking at average days on market and the number of properties that are for sale and that have sold,
Hmm.
when you're looking at comps, if you're seeing a lot of properties for sale but not many pending or sold, then you're probably going to have a hard time selling your comparable property in that same market.
Yeah,
You know, and the other end of that spectrum applies. If you're seeing a lot of sold but not many for sale, that might be a very good place to put a property on the market in. There may be high
yeah.
demand there, right, and not enough inventory in that particular area. So I think, but looking at days on market is important to try to determine, if this is the right place for me to invest. Back on the flood zone, discussion. If you're around a bunch of properties that are elevated 8 to 10 feet above the ground, and yours is a pier and beam that's about 3 foot off the ground, your property is probably a lot less desirable than those other ones around you. So don't lose sight of the forest when you're just looking at your one tree. Look at the other properties around you on the street as well. That's the other thing too, right? Some of these neighborhoods in Houston are kind of street by street, block by block, and they're gentrifying or they're turning, but you may be in a property that is 4 or 5 blocks from that path of progress,
Yeah,
and so you don't necessarily want to start that wave. You want to be in that wave and ride that
right.
wave.
Yeah.
So paying attention to that, like instead of get from out and from in front of your computer, go drive the neighborhood, and then figure out if you're in the right area.
Three quick things that I want to add that throw these off. Garages. People buying homes and the square foot includes the garage because the garage was converted to a bedroom. That will mess your comps up really, really bad. You may have a 2,000 square foot home, but uh, 800 of those square feet used to be a garage, and now you don't
Mhm.
have a garage, and you're comparing it with other homes with a garage. Like that can really mess things up. Uh, any type of weird floor plans, any type of add-ons or extensions that don't look natural, you got to keep in mind. You may say price per square foot. This pencils out. When you look at all the numbers and the data, it all pencils out. But at the end of the day, like when a buyer sees two homes and one has a really nice, smooth floor plan and the other is kind of a wonky, awkward floor plan, they're going to pick the nice one every time. So taking those kind of little things into consideration. So we can probably talk a lot more about running comps on stuff, but the other mistake is over budgeting. Um,
Or under
this
budget.
under budgeting,
Yeah.
going over budget. So under budgeting, you always want to put in some cushion in there. I think a, a lot of the cost of materials are volatile right now, like lumber costs are all over the place. Um,
Yeah.
just double
Wiring,
checking those.
wiring, copper, like all those things.
Yeah. And another thing that with the budgeting, uh, depending on the city that you're flipping in, make sure you know like what permits need to be pulled because we had a client do a bunch of electric work. and then drywalled the entire house after gutting and doing plumbing and electrical. City came in and said, "We need you to pull the drywall because we got to inspect all this electric behind the drywall," and that got expensive. So that was an
Yeah.
expensive mistake. So, and then number three, no exit strategy. You got to have three strategies. If you're, and I think I started talking mentioning this earlier. Number one, if you're going to flip it, my number one goal is to flip it. But if I can't flip it, I want to hold it as a rental. And if I can't hold it as a rental, I'm going to move in it myself. So that
Yes.
may
Those
be
are three
something.
exit strategies.
Yeah. Yeah. So worst case scenario, I'm going to move into it myself or let somebody I know move into it for a year or 2 years until the market rebounds or till
Hmm.
I get enough equity in the deal.
No, that's good.
Uh,
You want to have multiple exit strategies. That's all I
multiple
got.
exit strategies.
Mhm.
Number four, um, par- partnering with bad contractors. That's where I
Yeah.
think it's in my opinion, it's better to have one solid go-to contractor that you can rely on that knows you and understands you, like, and trust. It's it's and maybe paying him a little bit more than if you always want the lowest bidder. I think having that attitude can come back to bite us, just letting all
Yeah.
these different contractors come out and going with the lowest bid. That may not yield the best outcome in that situation.
Right.
Um, Getting stuck in the loan past the term, so be aware of your terms. If you're flipping a house, you really need to go fast. And if your
Yes.
contractor's not able to go fast, um, find another contractor. So
Yeah. Yeah, that's the whole reason why you have hard money is for it to be short term, and you don't want to like eat up all of your profit margin by paying all of those interest payments every month.
yeah,
So, yeah, you want to go fast, and that ties in with having reputable, solid contractors as well that also understand that they need to go fast, don't cut corners, but we need to keep this project moving,
yeah.
you know. Hmm.
Another one that's not on here that I have seen a few times is people get into DIY mode.
Oh
Um,
yeah.
that the DIY mode may make sense on paper, but at the end of the day, if you don't have the experience to float drywall and your drywall doesn't look good, like people are going to call you out on that all day long.
Hmm.
So, and then the last one we have is trusting the wrong lender. It's important to be in business with people you like, and
Yeah.
trust. So, any other common mistakes? Also, if you're on the call and you have, an experience, you have a mistake that you want to share, maybe a mistake that your friend made, not you, of course, uh, drop it in the chat box. What do you have? What's your biggest mistake, Alberto? Tell us the dumbest thing you've ever done.
With a hard money lender?
Sure.
Um, Honestly, I think using hard money lender, I mentioned to you before how they have like these programs where they'll like move you into this DSCR loan or this long-term loan on your flip. I mean, I'm sorry, on your rental rehab. I tried to do that twice with two different hard money lenders, and their rates were just horrible. Their fees were horrible,
Hmm.
compared to what I ended up getting afterwards with other more traditional banks that focused like that was their bread and butter was DSCR. Using a
Yeah.
hard money lender to just go into a 30-year mortgage after that was not a very good experience. So I would never do that again, to be honest with you, just because they do like I felt like there was this rug pull at the end.
Right.
They make it sound so great in the beginning, but at the end it just wasn't as good as they made it sound in the beginning.
Yeah. Yeah. And just knowing the numbers, being able to calculate the cost and
Yeah.
be ready for what happens when it all goes wrong. So
Yeah.
there are a couple of things to keep in mind. So we always want to hope for the best and aim for the best and prepare for the worst. So what happens if you can't sell or if you can't refinance? So first, if you can't sell, what do you do?
Well, you try to refinance.
You try to refinance. What happens if you can't refinance?
Well, I'll tell you, you can always refinance, in my opinion. It just may not be the terms that you want. Like for instance, let's say you thought that property was worth $500,000
Yeah.
and you couldn't sell
Yeah.
it for $500,000 and you dropped and dropped and dropped the price and now you're at 450 or 420 and you're like, you know what, screw this, I just want to get my money out, so I'm going to go refinance it. And you're like, hey, I just need that $500,000 appraisal.
Yeah.
That's how I underwrote the property. Well, you get that $500,000 appraisal, and that bank tells you, whoa, you couldn't sell it at 500. You're listed at 420 now. The most we'll even think about giving you on this appraisal is going to be
Yeah.
420. And
That's
that's
right.
going to throw your numbers off. They
Yeah.
will do the refinance. You may just have to leave a lot of money in that deal, or worse, bring money to closing to get out of that long term, that short term high interest loan. Right?
That's
I've
right.
never been in a situation where I couldn't refinance. So that's me. 25 deals. I've never been in a deal where I couldn't refinance. I've been in several deals where the refinance just didn't look pretty, but it was something that I just had to bite the bullet and move forward to stop paying interest on that high
Yeah.
interest loan.
I appreciate you sharing that. And I will have you know that not everybody thinks that way. And we have run into the investor or two or 10 that did not have a plan B. So I would say you need to be prepared to refinance. You need to be pre-qualified. Um, it's good to have a conventional lender in place just in case
Right.
you're not able to sell this property uh, for as much as you can.
Yeah.
Also, a wise man builds his house on the rock, not the sand. If you're building your house on the rock, you're going to have some emergency funds, some cash.
Yeah.
Um, it's okay to lose money on a deal from time to time as long as you're making money overall. But if you're putting
100%.
all your eggs in one basket, you're asking for trouble.
Yes.
Um,
Yes.
what if you stop making payments? Well, don't stop making
Don't
payments. Is
don't
is
ever
the
stop
first
making payments. No.
is the first
Like you
advice.
you go figure you figure it out how to make those payments. Like you got to get a personal loan, you got to go talk to your parents, talk to your friends, bring you I've had people, not for me, but I've heard people bring in other investors. They'll invest in that property. They'll bring some equity to that property to just get over this hump, right? Or to get the refinance done. You can get creative. Bring in a partner if you need
Yeah,
to. But
get
do
help
not stop making payments.
and communicate. Can you negotiate extensions? Yes.
Yes.
Uh, but you got to talk. You got to communicate. You got to tell your lender, hey, this is not going the way. There can be surprises. There can be, maybe you found out that there was an environmental hazard on the property. Nobody had any idea. And that's that, we had a client years ago, they bought a piece of land to develop on just to realize that back in the 60s and 70s, it was a landfill.
Yeah.
Those issues like that do happen, and every experienced investor has an experience like that. Maybe not to that level,
Yeah.
um, but communicate with your lenders. Most lenders are happy to work with their clients if they know
Yep.
that their clients are doing everything they can to make the deal work. Foreclosures, what do they actually look like? You just lose the property.
Yeah, you
Y-
lose the property. Some lenders, if you close the property in your LLC, some lenders will then report that on your personal income, on your personal credit if you default. So don't think that you're protected, by
right.
just letting your LLC foreclose. That can still come back to haunt you. So be
Yeah.
careful.
Is it better to sell at a loss or,
Yes.
yeah, default? Yes, it's better to,
Yeah, is it better to sell at a loss? Stop. That's it.
yes,
Like just get out, stop the bleeding. Do not default.
dude,
Ethically, it's not a good thing to do. Just pay your debts and take the loss. Figure it
that's
out.
right.
Yeah.
Very good. So, a couple of tips, and we'll end with this. Relationship, as we say in every episode, this is the key of the game, is building relationships before, during, after the deal.
Hmm.
Build loyalty with people you're in business with. Life will get better and better and better when you treat
Yes.
people well and talk to them. Um,
Operate
Stress test your
honestly, and with integrity, and people are going to see that, you know? So like just that should be that's your benchmark. You know, that is your
yeah.
baseline, you know? You're never below that. You only operate above it.
Stress test your exit plan. I love that one. Just
Hmm.
and I like the three, you know. Can you really see yourself holding on to it for a year or two? And we have that. We have some guys holding on to properties that and I'll tell you, like you're better off holding on to this. Market's kind of
Yeah,
crazy, but things are going to pick
right.
up. Um, Reserve extra capital for holding costs,
Yeah.
100%. You always want to have a cushion in there. We can talk about how much, that might be, but 20% is probably a good start.
Yeah.
Just having that in reserves. Uh, Underwrite, and then this is a good one too. Underwrite it with the hard money as well as long-term financing in mind. You always want to be prepared to hold on to a property you're
Yeah,
trying to
because
flip.
people
And
don't like, whenever you're looking at a property for a flip, you're kind of looking at it with rose-colored glasses, especially in the beginning of the deal. Like, oh man, this
yeah,
is a killer deal. I'm getting it really cheap, and the renovation is only going to be this. We're going to make $100,000, and you're not even thinking that you might have to refinance that property,
yeah,
But I think if you get pre-approved, like you mentioned before, hey, what do you like long-term? What do you think this property would be worth? And they may come back and just like shoot your deal down, right, with a really
yeah.
low appraisal, and that might give you pause, right? Is this really the deal that you want to go after?
Yeah, absolutely. We like to double list properties. So we'll take a property, like an investment property, and we'll list it for
Yeah.
sale and for lease just to see
Hmm.
what the best outcome is. So that's, being in a position to be able to go both ways is advantageous. So
Yeah. Yeah.
um we are just about out of time. I think we hit a lot of stuff. How much money should you bring to the table? It's going to depend on the deal. Um, Usually, probably, 10 to 20% might be a good starting point, but have that
At least have that
conversation.
have that in the bank. Yeah.
Yeah, have that conversation with your lender. Have that money in the bank. Can I use hard money to buy a duplex and live in one side? If you're going to hold on to it, you need to refinance it to conventional. Do hard money lenders care about credit? Yes and no, right? So they
Right.
not as much as the conventional, but it does. If you have terrible credit, like there's a reason for that,
Yes.
and it's your fault too. So, what happens if I need more money mid rehab? Talk to your lender. They do. Our hard money lenders will do draws through that.
Well, I mean, if you need more money, let's say you're over budget, right?
Hmm.
I know some hard money lenders that would do a second position lien
Yeah,
loan at a much higher interest rate, but they will loan you the money. Some of them
yeah.
will if they think it's a solid deal for you to get through that rehab. Like you mentioned before, talk to your lender.
So homework this week: get get in relationship with two or three hard money lenders. That's really like the biggest thing from this one. If you're wanting to
Right.
flip, buy, hold, you can even use hard money for your house. If you're looking for that dream house and you see a diamond in the rough that needs 100,000 in rehab, you can use hard money for that, buy it, and then finance it conventional, and your family can live in it. You can homestead it. So, being in relationship with these guys, it's critical. And know your numbers. Don't guess. Don't guess on these. It's too much money, and you can really mess yourself up. So, any last
Yeah.
words, brother?
No, that's it, man. I mean, we covered a lot. That was fire hose today. It
Yeah,
felt like it was a lot.
they
It was good.
they are. We're going to talk about private money, and we'll probably revisit a couple of the same topics with the private money. But raising capital the right way. We could even talk about being a private money lender. If we have time, we can look at it from the other side of things because we have a lot of people on this call that may just be more interested in lending on the lending
Yeah.
side of it. So I think next week will be a good time to talk about that. And then week three, we'll talk about the DSCR loans, the HELOCs, the SBA loans, the options there. So appreciate it. Thanks for everyone being on the call. Don't forget to like and subscribe on YouTube. Look for us on Apple Podcasts, Spotify, and Facebook. Until then,
Awesome.
I'm Austin from Houston. My brother,
I'm
Alberto
Alberto.
Medellin. Appreciate you, man.
All right. Have a good one,
Have
y'all.
a have a good one. Thanks, Rick. Bye.